Right, your pal, JSnip4, video number 2, Monday morning. Zero Hedge article. This is the nightmare scenario for the GOP, the Republicans. A $2 trillion funding hole. And this is a video I was just telling you about in my previous video, that because they couldn't repeal Obamacare, it's now dead in the water. It's setting up a problem for tax reform as well. When one strips away the partisan rhetoric and posturing, the practical impact of Friday's GOP failure to repeal Obamacare has a specific monetary impact, approximately $1 trillion. Since the Obamacare repeal bill would have eliminated most of the 2010 health laws taxes, this would have lowered by a similar amount the revenue baseline for tax reform. Essentially, with the Obamacare taxes gone, it would have been easier to pay for lowering the tax rates. Now, if Republicans want to eliminate the Obamacare taxes as part of tax reform and ensure the bill does not add to the deficit, which they need to do to assure Trump's reform process continues under reconciliation, avoiding the need for 60 votes in the Senate, they will have to raise almost $1 trillion in revenue. In other words, that all else equal is how much less tax cuts Trump's and the Republicans will be able to pursue, unless, of course, they somehow find a source of $1 trillion in tax revenue, or otherwise simply add to the budget deficit to offset the Obamacare overhang. Considering Paul Ryan's statement on Friday, it appears that at least for the time being, Republicans would leave the Obamacare taxes in place. Quote, "That just means the Obamacare taxes can stay with Obamacare," he said. "We're going to fix the rest of the tax code." Ryan also pushed back on the idea that the setback on health care previews difficulties with other items on the legislative agenda. Quote, "I don't think this is prologue to other future things because members realize there are other parts of our agenda that people have even more agreement on what to achieve," he said. "We have even more agreement on the need and the nature of tax reform, on funding the government, on rebuilding the military, on securing the border." End quote. While the failure to pass the health care bill makes tax reform harder, it does not in any way make it impossible, Ryan said. "We will proceed with tax reform. We will continue with tax reform." Earlier in the week, Treasury Secretary Steven Mnuchin said that the administration has been working on tax reform for 2 months and plans to release a plan in the near future. House Ways and Means Committee Chairman Kevin Brady added in a statement that Republicans on his panel are moving full speed ahead with President Trump on the first pro-growth tax reform in a generation. Still, quick action on legislation is unlikely. In fact, while the market narrative changed on a dime last Friday, the traders now convincing themselves the delay of Obamacare means tax reform passes quicker, this is not the case. As Larry Lindsey, a former economic advisor for George W. Bush, told CNBC's Power Lunch last Friday, one of the silliest things he's heard from people is that the health care proposal not passing will be good for Trump's tax reform. Absolutely not, he said. A replacement for Obamacare was necessary for budgetary reasons for tax reform because it was a revenue gainer, said Lindsey. Trump's goals for economic growth should also be questioned now, he warned. He says they might move on to tax reform next, but but when you have a president who can't deliver his own caucus, then the president's position will be weakened on all issues, he said. If you're in Congress and you don't like something, you now have an example of how you can roll the president. Zero Hedge says, but wait, there's more. While the GOP will be hard-pressed to find $1 trillion in offsetting savings or revenues, their headaches could be doubled if the proposed border adjustment tax fails to pass next. As a reminder, BAT is expected to generate as much as $1.18 trillion in offsetting revenues. Should BAT not be DOA, That's another $1.2 trillion in potential government revenues that is gone. According to James Pethokakis of the American Enterprise Institute of Economic Policy, the fact that the Republicans failed to pass a health care reform bill makes the odds that they will pass a border adjustment provision much smaller. And the odds of getting a bigger stimulus plan will drop too, he also told CNBC on Friday. Investors won't get to see cuts to a 15 to 20% tax rate in corporate and marginal tax rates as those Trump has proposed. He added. Instead, it will likely be closer to what Obama worked towards, something closer to a 30% tax rate. He said it raised the specter of more discontent among Trump's longtime supporters, considering he campaigned on that specific promise. Echoing this sentiment, Jared Bernstein, a senior fellow from the Center on Budget and Policy Priorities, said in an interview that tax reform and the health care proposal were intimately connected for precise reasons. Trump once suggested achieving growth of 2 to 4%, but this might look like 1 to 2% now because of budgetary constraints, he added. Now the government has less money available to hit high revenue targets, Bernstein said. Summarizing the above, as a result of Friday's failure, the tax revenue hole Republicans have to fill now is at least $1 trillion bigger and perhaps as large as $2.2 trillion. Zero says, but wait, there's even more. And as the Wall Street Journal writes overnight, in theory, rewriting the tax code could be easier than revamping the whole healthcare industry. Republicans provide themselves on ideological unity in favor of lower taxes, and the stakes appear lower for Americans. Paperwork and money are far different than matters of life and death. Tax reform is less visceral, said Representative David Squirkert, I'm not sure how to pronounce his name, Republican, Arizona. I can pull up a calculator and say it's this or this. It's hard legislating to anecdotes and stories. But scratch deeper, and the GOP quest for a full overhaul of the tax code is fraught with squabbles, procedural hurdles, and difficult trade-offs. The party's failure on health care, after having 7 years to prepare, shows how hard it is for Republicans to write complex legislation that attracts support from their moderate and conservative wings. Quote, it's just a reminder of how incredible hard transformational legislation is, said John Gimigliano, or is that Gimigliano? Or Jingle Bell, a former GOP congressional tax aide, now at KPMG LLP. As the Wall Street Journal notes, to succeed, Republicans need to bridge at least three big gaps. First, they need to balance competing desires to cut tax rates sharply and to slow the rise of national debt. Good luck with that. Did you hear that last one? Slow the rise of national debt? Has anyone not seen these charts over the last 15 years? They ain't no slowing that puppy down. Republican leaders in Congress said they want a revenue-neutral plan, one that brings in about as much money as today's tax system. Faster economic growth might help, but it doesn't fully bridge the divide. The accomplishment, revenue neutrality, while sharply lowering taxes, they will attempt to whack popular tax breaks, such as business deductions of interest on debt and individual state and local tax deductions. They will meet resistance from groups that want to protect those breaks. Second, they have to reconcile alternate visions of what they are setting out to accomplish and who will benefit. Mr. Trump has said his priority is middle-class tax cuts for individuals, not the top 1%, said Mr. Mnuchin. House Speaker Paul Ryan and Ways and Means Chairman Kevin Brady want an overhaul primarily focused on promoting economic growth, even if that means tax cuts that favor the very top of the income scale. The plans they all campaigned on are tilted to the top, according to independent analysis. Third, the party is at odds over the Ryan Brady plan for border adjustment, taxing imports and exempting exports. The Trump administration has been ambivalent and sometimes critical of the idea. Senate Republicans are outright cold to it. Ryan and Brady say it's crucial because it provides about $1 trillion to offset corporate tax rate cuts and it discourages companies from shifting profits abroad. None of those divisions inside the GOP have been resolved yet, and dozens more are lurking, including debates over tax breaks for renewable energy, credits that aid low American income households, and the treatment of carried interest income for private equity managers. The quote, the notion that tax is easier than health is not born out of the facts, end quote, a Senate GOP aide told the Wall Street Journal. Having discussed health care for 7 years, Republicans were 75% in agreement on the policy. On tax, none of the foundational questions have been answered. So in short, the market is about to be significantly, perhaps tremendously, disappointed once again and quite soon. And on that note, there was an interesting article from Silver Doctors. That was Zero Hedge. The Big Short, Part 2. But upon reading this, I don't know if I'd really call it that, but again, remember the movie The Big Short? And I think that's what he's referring to, the movie The Big Short Part 2. But no, there's not a Part 2 of the movie. It's going to be real life. Submitted by Precious Metals Fund Manager Dave Kranzler. And that was investmentresearchdynamics.com. He's got an article here on Silver Doctors. I like this guy a lot. Truth is like poetry, and most people effing hate poetry. Ron Paul was on Fox Business last week explaining that stocks and bonds are in a big bubble. He said that you need to short this market. As is my modus operandi, I had the volume muted, so I didn't get to hear Fox's host's exasperation. Interestingly, it was reported last week that the short interest in the S&P 500 ETF, SPY, hit an all-time low on March 7th. So nobody's shorting, according to March 7th. This is a fantastic contrarian indicator. It also removes the general short squeeze risk from the risk of shorting the market. Perhaps more curious than Ron Paul's comments was the warning about the stock market issued by Robert Shiller, who typically is a Wall Street apologist. In an interview on Bloomberg this past Tuesday, he said, the market is way overpriced. It is not as intellectual as people would think or as economists would have you believe, end quote. Shiller is noted for his warnings about the tech bubble in 1999 and the mid-2000 housing bubble before it collapsed. And what is he saying? The market is way overpriced. Not overpriced, not a little over, way overpriced. And I've shown you the charts, price and earnings, it's supposed to follow, okay? And then you see this, the price of the stock, Dow Jones or S&P, whatever one, way the hell up here, price, but if you look at P&E, it should be way down here because one's way down here, one's way up here. I mean, like he said, not a little bit. They're not just off a little bit. They are way off. And it's going to correct, and it's going to not be too pretty, okay? It's going down. I don't know how far it'll correct the first time. But again, we still got till May 11th. Can't remember the guy's name now. Talked about him 3 or 4 times already. That said, watch March 13th, that week, or that day. Any signs of rockiness, shakiness in the market? Absolutely. We had 6 straight days or so of down Dow Jones, and he mentioned Dow Jones, but said don't even worry about that anyways. May 11th is the big one. That's the date that's more concerning. We should really pay attention to that date for markets. So we got about a month or so, right? We got about a month left. Perhaps more curious than Ron Paul's comments. Oh, wait a minute. No, that was him. Extreme levels in consumer confidence, investor sentiment, valuations, and a deep incline in stock prices have historically marked market peaks. A week ago, investors' intelligence, bullish sentiment among investment advisors hit its highest level in 30 years. That previous peak corresponded to the market peak in 1987. The 1987 stock crash was the steepest in history. Consumer confidence hit a 2016 year high. The prior peak in consumer confidence occurred right before the tech bubble crashed in 2000. As detailed, and again, what does that mean, peak? This consumer confidence, all this crap. That's you and I. The people who are last to the party every single time, like I always say. We're last to the party. We think we're going to get on there, ride it up, and then we get absolutely crushed. And if you have a 401k and you see this coming, call the HR. Get my money, park it on the side in cash. I don't want to be in the market. Take me out of that exposure. Oh, I'm sorry. Your company doesn't have that level of a plan with us. You have to upgrade. So if I know my money's about to get destroyed and I'm telling you, get my money out of there, you're telling me I can't. Well, you could pull it out early if you are in a hardship, financial hardship. I'm not in a financial hardship. I work every day. I'm good to go. But I am still concerned about my money, and I'd like to move it out of the system. Well, we could put it in some, you can just modify your plan and put it in the safer stuff. No, I don't want the safer stuff either. The whole ship's sinking. You want me to move my stuff to a different part of the ship. The ship is sinking. I want it off the ship. Yeah, you don't have that plan with us. So what do? I don't know what to tell you, sir. Have your company upgrade the plan. Like I've always said, that 401k is a huge boat anchor with an invisible chain attached to your leg. And you don't even know it's there. You can't even feel it. And when that sucker gets thrown overboard, you're getting jerked hard into that water. Okay? Let's see, where were I? As detailed in recent short sellers journals, the retail mom and pop investor has been piling into the market since the beginning of the year. When the realization that Trump's campaign promises will never become reality and the music stops in the stock market, there will be a broad base of retail stock geniuses looking for seats, like when the music stops, seats that don't exist. The stock market is perhaps the most disconnected from the underlying fundamental systemic reality than at any time in history. This is true if we were to evaluate the total amount of debt as a percentage of GDP, which is about 345%. At the beginning of 2000, it was about 270%. If we were to adjust to the current level of GAAP, GAAP, earnings for the S&P 500 using the GAAP standards applied in 2000, it's likely that current price earnings ratio for the SPX would be at least as high as it was in 2000. And recently it was revealed that retail traffic at malls across the country has fallen off a cliff 15% in February and another 13% so far in March. Used car prices are plunging, which reflects both an oversupply of used cars and a big fall off in demand. And what I just read you the video before this, super duper condo things down in Miami. A glut of condos, no one in them. Add that to the list. And again, go to Zillow.com, open up Miami, Florida, or any major city in Florida, and look at how many houses are for sale. And then look at the blue ones who are foreclosed in auctions, as I keep saying. The red ones are just people selling them, or even companies, whoever's selling the house, they own it. They're not a foreclosure or an auction. And you will see so much on the market, it will make your head spin. Make your head spin. So, anyways, this will quickly spill over into the new car market, which faces a record level of dealer inventory, and bank loan creation has begun to rip in reverse. Bank loan creation is a product of both demand and supply. A drop of the magnitude shown above, which he's got a little chart, which this is going to be quite small, but let me zoom in. 2008, 9, 10, 11, 12, 13, 14, 15, 16, and 17. So once again, 2008-9 crisis, boom. Then, recovery, we're in recovery. Okay, QE, everything, let's start lending again. Boom, back down, a little bit up, and then what do you see here? Especially right here. Right as we leave 2016 and get into 2017. Not looking too smurfy. Okay? Anyways, bank loan creation is a product of both demand and supply. A drop of the magnitude shown above occurs because borrowers have stopped forming new businesses or expanding current businesses, except for real estate developers who will borrow relentlessly until the bank cuts them off. and condo developers, right? And banks have determined that in the current economic environment, the risk of losing money from lending to businesses and consumers exceeds the potential return, or real estate developers are finally getting cut off. So in short, based on the above fundamental data, the economy, for the most part, has fallen off a cliff. Extreme levels in consumer confidence, investor sentiment, valuations, and a steep incline in stock prices have historically marked market peaks. A week ago, Investors Intelligence bullish sentiment among investor advisors hit its highest level in 30 years. That previous peak corresponded to the market peak in 1987, and by the way, the 1987 crash was the steepest in history. Consumer confidence hit a 16-year high. The prior peak in consumer confidence occurred right before the tech bubble crashed in 2000 as well. Most of the above commentary is excerpted from the latest issue, released Sunday, of IRD's Short Sellers Journal. The primary short idea presented is down 4.7% from last Friday's close. I just closed out a put option from an idea I presented, including the put option I would be buying, 2 weeks ago for an easy 30% gain. If you are interested in learning how to make money shorting the most overvalued market in history, click here for the short seller subscription. I have a feeling in a few years people are going to be doing what they always do when the economy tanks. They will be blaming immigrants and poor people. And that's from the movie The Big Short, he says. I'm telling you, like, September 23rd, the date in the movies, it's always there, but they never put the year. Even with 9/11, it's always like 9/11, 9/11. You know, back before even 9/11 happened, it was 9/11. You'd see it here and there. But the next biggest date we keep seeing in the movies is 9/23. Wasn't 2015, wasn't 2016. Will it be 2017? It could very well be. The party could get started September 23rd, 2017. Or is it going to be 2018? When the Economist magazine says get ready for a new world currency because paper money is going to be on fire and a phoenix is rising from the ashes with a gold coin around its neck. Hint, hint. And the coin has a zero with a big line through it. You know, like digital? What are you trying to tell us? Bitcoin? Cryptocurrency? What does that mean? I think we're going to find out. And I think their timing from 30 years ago, 1988, they knew then. They knew exactly then because they could calculate everything then. You can calculate a forecast very easily. As long as you have data, the data is legit, you can calculate anything, growth, everything. And I'm sure they had legit data. They may not share that with you and I, but they had some legit data, and I bet it pointed to 2018 perfectly for them. And what chances are there right now that all these videos that I'm doing in the last 2 months, out of control, by the way, same topic, or same few topics like rapid fire, man, can I stop doing this? Is there anything else? I mean, I know there's other gloom and doom out there happening, but these keep up. Housing, market overvalued. Housing, market overvalued. Auto loans, subprime, markets, housing overvalued. Again, it's coming faster, faster, faster. What I say about that? I think we're leading to a peak. I think it really could be later this year, because by later this year, Trump and the tax thing didn't get done. The ObamaCare thing didn't get, now what's the market relying on? Okay, he's done. They didn't work with him. It's not going to happen. Floor falls out. Perfectly timed, of course, and it's only going to fall out when the club wants it to fall out, but they like to put those numbers in our face, 9/23, so maybe it'll be September 23 this year. Then again, maybe not. All I know is, regardless of dates and trying to figure out when it's going to happen, it can't be too far off. It cannot be too far off with all the data that I'm sharing with you every day. There's no chance. That that's going to be far off. Take care.